Hello and welcome to the latest episode of On the Money, which is a weekly look how to make the most out of your savings and investments. Before we go any further, I just wanted to flag that next week's podcast episode will be a day later than usual. So the episode is going to analyse the personal finance measures announced in the budget. And to be totally honest, I feel the episode will benefit from not rushing it out and having a bit more time to analyse the contents of the famous red briefcase. So that episode will be published on the Friday the 28th of November, and I'll be joined by II's personal finance editor, Craig Rickman, to provide his expert analysis. Today, we're going to be looking at how investors' favourite funds have changed in 2025, and I'm delighted to be joined by II's newest recruit, who is Dave Baxter. You may be familiar with Dave, particularly if you are a subscriber to the Investors Chronicle, as Dave has been the funds editor of Investors Chronicle for many years until he recently joined II. Dave, thanks for coming on the podcast.
Thank you very much for having me.
So Dave, we're going to be covering today the II Top 50 Funds Index. So this is a quarterly report in which we rank the most bought funds, investment trusts and ETFs. Essentially, it's a big league table that indicates what is popular with retail investors at the moment. I'm going to be talking about some of the key trends within that index. The first thing we're going to cover, Dave, which stands out, is the Fundsmith Equity is no longer in that II Top 50 Fund Index. So it's been in the index since we started it, which was in the summer of last year. However, it is no longer in the index. Why do you think, Dave, that Fundsmith Equity has become less popular with retail investors?
So I guess the main guess would be one word: performance. Perhaps we should caveat, as we'll get into it, long-term performance has been good and you've still made gains from holding Fundsmith Equity. But if you look at recent years, since 2021, it's basically underperformed the MSCI World Index for every single calendar year. It looks, unless things change dramatically in the next few weeks, it looks like we'll see that again in 2025. So my assumption would be that people have simply been, looking elsewhere, either thinking, I'll just buy a global tracker or even going for some different active funds. It is worth noting, obviously it's been difficult for an active fund in recent years to even keep pace with the MSCI World Index for reasons that we'll discuss. But if you now look on a 5-year stretch, it sits in the fourth quartile of the Investment Association's global fund sector. So, and I guess just to touch on the reasons behind that underperformance, Terry Smith has been very open about this in recent years. The obvious one is the classic, lament of the active manager. The MSCI World Index is chock-a-block with those so-called Mag 7 stocks, the kind of big tech names. And, for diversification purposes and just out of preference, Terry hasn't had as much in them. He hasn't held Nvidia. He does have a big Microsoft position. He has made a lot of money off Meta, but he's not as heavily, in there as a tracker fund will be. A couple of other points just worth briefly mentioning. One is there have been points in the last 5 years or so when, so-called value stocks have done well, and Fundsmith hasn't held those. So in 2021, you had a bit of a comeback and they weren't able to kind of capture that upswing. And finally, there's a bit of stock-specific trouble in the form of Novo Nordisk, was a very popular stock, a real market darling. And Fundsmith did have a lot of exposure there, but I was looking just before we started recording, and over 12 months, it's down something like 60% because it's had various missteps.
You've just mentioned Novo Nordisk. Terry Smith, in his half-yearly letter to investors, he writes 2 letters a year, which the vast majority of fund managers don't do. So I think it's refreshing that he writes these letters and that he is pretty transparent in terms of giving investment commentary and explaining why the fund has underperformed, if it has underperformed. So for the first half of this year, he mentioned that Novo Nordisk was one of the main reasons why the fund had underperformed versus the MSCI World Index. And my understanding is that, as you mentioned, Dave, from its peak, which was around last summer, the share prices fell about 60%. And my understanding is that's because it's lost some ground to its main competitor called Eli Lilly. And the fact is that it was first to market with one of its weight loss drugs. That gave investors a lot of excitement. It caused the share price to go up a lot. The valuation went up a lot. And there's been sort of like a natural correction due to the fact that the share price had that strong run and the valuation became pretty expensive. You also touched on the Magnificent Seven. On a 5-year view, that has been a big headwind for Fundsmith Equity. It's also been a big headwind for a lot of actively managed global funds. The MSCI World Index has been a very hard index to beat over the past 5 years due to the fact that how concentrated the returns have been in a handful of the biggest technology stocks, which are listed on the US stock market. In terms of performance, you mentioned the fund has fallen into the fourth quartile of its sector, which is the Investment Association Global Sector. Just to put some figures on that, so Fundsmith Equity over 5 years, its returns 33.8% versus 54.9% for the average global fund. For that sector, there's a couple of hundred funds. The majority of them are actively managed funds, but there will be some index funds within that sector as well. But as you say, Dave, if you bought the fund at launch and you've held on throughout, you've done very well. It's outperformed since launch. So since 2010, the fund's up 14% on an annualized basis. And that compares to 12.4% on an annualized basis for the MSCI World Index. But over the past couple of years, that gap has certainly narrowed due to its performance lagging over shorter-term time periods. And when I say shorter-term time periods, I do think 5 years now, it is a time period that may be concerning for investors. That's not necessarily a short amount of time. 5 years is seen as a very good measure to analyse fund performance due to the fact that in that time period, you're going to get both rising and falling markets.
Difficult, isn't it? Because in particular, with kind of active funds, you think, these things can be a bit cyclical. You can go in and out of favor. And sometimes you do need to just exercise that patience and think, I believe in the process. They're still being consistent with how they operate. But it's very psychologically understandable if you're now heading to the point where you're thinking, oh, okay, it's been 5 years. And as you say, that gap is sort of getting bigger and bigger.
In terms of its fund size, there's been lots of articles written over the years about how big the fund is and whether this means that the fund manager, of course, Terry Smith, is constrained by that size. What are your thoughts, Dave? I mean, I assume if you're still holding the fund and you're hoping for a recovery to play out, due to its sheer size, it's not going to go down the market cap spectrum and have lots of mid caps and small caps. It simply cannot do that. But then again, on the other hand, you wouldn't expect the fund to do that. It does invest in really big companies. So it's not going to change. It's going to stick to its knitting, and its investment process is going to stay the same anyway.
Yeah, it's interesting because it shouldn't really struggle with liquidity because, as you said, it invests in these behemoth companies. I was looking at the end of October and its median market cap of the holding is nearly £104 billion, I believe. So you're not going to have huge trouble sort of buying and selling. However, as you mentioned, you can't necessarily buy some companies that will drive some growth. And if you look back to his earlier years or the fund's earlier years, there are holdings like, Domino's Pizza is one. I think you've mentioned before that they did hold at some point, generated some quite nice returns, but now owing to the sheer size of the fund, but they just won't be able to hold that. So you are potentially having to go for companies that have less in the way of kind of exciting and rapid growth, which could have an impact. Although I suppose one strange silver lining of the kind of outflows is that the fund it's huge, but it's not as huge as it was. So it's around 17 billion in size now. And you think at its peak, it was at least over 25 billion. So bizarrely, maybe one of those problems is slightly kind of less of a problem than it was before.
So we asked some of our customers for their views on Fundsmith Equity. And we did this on our new, it's been going for a while now, but our II Community app. So for those that are not familiar, II Community, it's a social trading network in which you can connect with investors, talk about your investments, and see how your portfolio compares to others. So it's free for II customers, so do check it out and please do get involved. So I asked those on the II Community, of which there are now over 30,000 members, what their views are on Fundsmith Equity and whether they've been holding or selling, whether they've made any changes. There was lots of great interaction. There was 58 comments to the post. And in the main, most people who responded said that they'd either completely sold out or they now had a small holding in Fundsmith Equity. And that's on the back of its performance in recent years, underperforming the MSCI World Index. There didn't seem to be much optimism in terms of them expecting performance to turn around. And some of the people that commented were comparing Fundsmith's fee with a low-cost tracker fund and saying, well, at the end of the day, if you've bought an index fund or an ETF, then you've performed much better over that 5-year period.
The fee's an interesting point, isn't it? Because it's somewhere around the 1% mark, which is even a bit pricey for kind of an active fund. And they've never really brought the fee down, even as the fund has grown, which even when performance was really fantastic, that was a bit of a bone of contention among investors.
I completely agree, Dave. And I do think it's a shame that overall the fund industry doesn't typically pass on economies of scale. You do see it with investment trusts. When investment trusts reach a certain size or threshold, there's a tendency to lower the annual management fee. But I just don't think that happens that much with open-ended funds. And I'd love to see that happen more often, because at the end of the day, I think if you can pass on economies of scale, if it's cheaper to run as you've got more assets, then it'd be great if you could pass that on to the underlying investments in the form of a lower fee. Agreed.
I think at the end of the day, performance is still the main thing, but it's kind of the goodwill, isn't it? And if you are, like you said, if it's cheaper to run a fund, then pass it on.
Some of the customers who responded to the post on our II Community app pointed out that they had replaced Terry Smith with a global index fund or a global ETF. One thing I'd say on that is that whatever investments you have, I think it's really important that you have a diversified portfolio and that every single fund you own, whether it's an actively managed fund or you simply own in the market through an index fund or an ETF, that they're all bringing something different to the party and they are adding something to the portfolio, and you're not duplicating too much in terms of fund style and the underlying holdings as well. I do think if you own a global index fund or a global ETF, Fundsmith Equity, it's very different from the wider market. If it wasn't very different, then it wouldn't have underperformed over this 5-year period. However, there are lots of other options as well. There's lots of competition among active funds that can provide an alternative and complementary exposure to a global index fund or a global ETF. And within the comments on the II Community post, a couple of actively managed funds that were mentioned that investors said they had switched into were Ranmore Equity, Blue Whale Growth and Scottish Mortgage. I think you can certainly say with that trio, as well as Fundsmith Equity, they all are very different from the wider global stock market.
Yeah, I'd definitely agree with that. I think also particularly something I've really noticed in recent years is, this is me narrowing down slightly to the investment trust space, but if you look at the kind of the global sector there, you have all these quite interesting funds. You mentioned Scottish Mortgage, very distinctive kind of future trends. You have AVI Global that kind of does a slightly activist-y, value-focused approach, and just lots of stuff that is at least different from the index. Although, like you say, that will mean kind of underperformance when everything is just kind of running ahead with these few stocks.
Before we move on from Fundsmith, I think it'd be an oversight if we didn't mention the recent announcement from Smithson Investment Trust. So this is a global smaller companies, global mid-cap portfolio that was launched several years ago. At the time when it was launched, it was the largest investment trust IPO in the UK, and that remains the case today. There hasn't been an investment trust launched that's raised more money since then. So Dave, could you run through the details? So I'll kick off by saying it's proposing to turn into an open-ended fund. And if you disagree and you don't want the fund to turn into an open-ended fund, then you can get your capital back at close to net asset value. And one of the main reasons why they're proposing to move to this open-ended fund structure is because it's traded on a wide discount for a number of years now, but it also has an activist investor on its shareholder register called Saba Capital, who I assume have been applying some pressure in regards to that discount.
Yeah, I think this is really a Saba story because it's only a few weeks ago that it was, as we recently wrote, Saba has been targeting lots of investment trusts in the last 18 months, 2 years. But they do basically have to tell the market if they have a position that exceeds 5% of a trust or a company. And it was only, a handful of weeks ago that it came out that they had quite a big position in Smithson. And when Smithson made the announcement this week, they mentioned the fact that I think Saba had something like 16%. Saba has previously kind of pushed trusts such as recently Middlefield Canadian Income to move into other structures. And what's happening here is, as you mentioned, you have that discount. So your shares are in theory trading at kind of a lower value to the underlying assets. But if you kind of shunt it into an open-ended structure or an ETF structure, investors, including Saba, can then simply get out an NAV and kind of make a profit, at least versus that discount. So it's kind of, it's an interesting sign of, obviously some people don't really agree with what Saba's doing, but it is producing some results.
And in terms of the investment trust structure, I actually recently interviewed Simon Barnard, fund manager of the Smithson Investment Trust. And for those that didn't see it or would like to watch it, you can view that on Interact Investors' YouTube channel. I asked him the question regarding why is Smithson in an investment trust structure? Like, what is this structure giving you over an open-ended fund? As since Smithson launched, it's not used any gearing, and that is one of the key tools that an investment trust has. I asked him in respect of, does the structure of having a fixed pool of assets, does that mean that it's easier for you to own smaller companies? But the answer he gave was that he doesn't feel like he's being constrained in any way. He feels like he's getting enough liquidity. And I'm sure that was a lot of the thinking behind moving to an open-ended fund. Can we run the strategy in the same way? Can we get the same levels of liquidity? When I say liquidity, how easy it is to buy and sell smaller companies and mid-cap companies that the portfolio invests in through an open-ended format. And it seems to be, he said that is the case. So I think, as you've outlined, Dave, this move that's been proposed, it has been done in light of the activist investor, and it's to eliminate the discount. And I think if it goes ahead, I think it'll be really interesting to see how the fund size changes. As along with Saba, investors can take a view that, if they've been unhappy with the performance, then they can pull their money out at close to net asset value rather than sitting on a discount of over 10% at the moment.
It's interesting, isn't it? Yeah, because you think they're not going to miss out on some of the advantages of trusts. You mentioned gearing. They don't have enormous position sizes based on kind of recent disclosures, so they're not going to have problems with some of the diversification rules on open-ended funds. And obviously when we talk about small and mid-caps, if they're global small and mid-caps, they're still big companies. The one thing I do wonder is, obviously if you're a trust and you're unpopular, you can be plagued by a discount and that creates pressure. But if you're an open-ended fund and you're unpopular, then people will just drag their money out. So if they remain unpopular and they're in that structure, they may have a bit of a headache with trying to kind of create liquidity and just with the fund shrinking, and we'll see how that goes if that's the case.
Let's now move on to another fund that has been popular with interactive investor customers for the past couple of years, but it's become less popular this year, which is Jupiter India. So within our II Top 50 Index, a year ago it was 7th overall. It's now not even in the top 50. What are the main reasons for you, Dave, as to why that fund is not as popular as it once was?
I think it's probably just a victim of the market it fishes in falling out of favor. So a lot of this can be explained by looking at the performance figures. At the time of recording, that fund was sitting on, I think, a 5-year return of 169%. So, big return. But if you look at a 12-month return, it's on 4%. So the performance has come off a bit. Basically, I suppose with India, it was quite like a market darling of emerging markets in recent years. And that was helped by China being out of favor. But investors seem to have just kind of turned away from that market. It's partly, I believe, maybe it's a victim of its own success because people started to get concerned about prices being too high. And even if you look now, they do look quite high. For example, I recently looked at ETFs operating in Asia, and you can see the price earnings ratios in those. And the one on the India ETF is something like 25.5 times at the end of October. And that's just much higher. I think the China one, for example, is somewhere around the 16 mark. So it's still looking quite expensive. So maybe people are just kind of taking a step back, taking some profits and putting that money elsewhere.
I often find with some retail investors that India and China are pitted against each other, and that some investors, they like to have single country exposure to those regions. And as you've mentioned, Dave, I think the fact that China has been out of favour for the past 5 years, its valuation's cheaper than India. So I think some money's rotated into China and out of India. And within our II Top 50 Index for the third quarter, we saw Fidelity China Special Situations enter the index. It was one of 10 new entrants, and that's part of that trend. Let's now move on to what's not changed in terms of the most popular funds among our customers. So global strategies continue to be really popular with our customers. So within the II Top 50 Index, 17 of the 50 invest globally. Around 2/3 of that 17 are index funds or ETFs. So many investors are deciding, I just want to simply own the market through an index fund or an ETF, rather than try and beat it through a professional stock picker, who of course may outperform, but they may also underperform. And they may also heavily underperform. I think that's one of the key attractions with an index fund or an ETF is, as well as knowing what you're going to get on the tin, you also know you're not going to drastically underperform. It takes away that risk. What are your thoughts, Dave, on investors continuing to seek out global exposure? It's of course been a strong period for the global stock market. Whatever time frame you look at, 5, 10, 15 years.
Yeah, I think it's really interesting. I think you summed it up well. It's kind of seemingly does what it says in the tin. It's a simple thing. You're maybe getting like a very broad take on markets. But I do wonder whether people, have realized that this is a widely discussed thing, but have realized whether, global funds are often less global than you actually think, given, say, MSCI World is something like, 72% in US shares. So I don't know, there might be a risk now that some investors are getting too exposed to kind of one theme, to one handful of stocks and one market. And maybe they need to, obviously in the index, there are some kind of more nuanced funds and more nuanced, maybe less US heavy takes on kind of global markets. But yeah, some investors might still be kind of betting too big on like a few things.
An interesting trend we have seen is US focused funds become less popular. So in the fourth quarter of last year, there were 10 US funds in our II Top 50 Fund Index. There are now only 4. And all of them that are no longer in the index, they were tracker funds. They were either index funds or the ETFs that were tracking the up and down fortunes of a part of the US stock market. Investors were getting exposure to the S&P 500, but there was also demand for the technology NASDAQ index. So I do think that some investors become more conscious about US valuations, potentially the risk of a Donald Trump presidency, but also the fact that, as you've just mentioned, Dave, if you already have global exposure, particularly if you're already investing in global index funds or global ETFs, you've already got a very large portion of your money in the US stock market anyway. So there's a danger that you might duplicate.
Yeah, I think that's becoming an even bigger problem, actually. I believe in the last year, we reached a peak in terms of weighting the US has in the MSCI World Index. So that risk is even greater than it was just a few years ago.
For investors that are concerned about the concentration risk within the US stock market, there are various ways to lower that risk. You wrote a recent article, Dave, in which you outlined some of the options. Could you summarize those?
Yeah, there are some really interesting, weird and wonderful options out there. So you've got, for example, equal weight funds. So you can take an index like the MSCI World, also the S&P 500. And rather than doing market cap weighting, so, having Nvidia on a big weight, you would simply give roughly the same amount to every single stock. So in theory, you've got you do have less riding on those big stocks, but the criticism is that you might end up suffering if the market falls anyway. And when times are good, you might miss out on those big returns. And one other option worth mentioning, there are many US options, but one global option worth mentioning that's interesting is there's an MSCI World X or a few MSCI World X USA ETFs. So they just pull the USA out of the index. That does mean that you have some pretty chunky weightings to the other markets. Japan is on a big weighting, for example. UK is on a big weighting, and there's a smattering of decent allocations to European markets. But I guess you could hold that, and then you could hold a US tracker on a smaller weighting and just have a bit more of a kind of nuanced approach.
As I mentioned earlier, I think with an actively managed fund, it's really important to look under the bonnet, understand its strategy, and then look at it and think, how is this different from the index? And is it sufficiently different from the index? Will it potentially give me outperformance over time? We've seen this year increased demand for value-focused funds, which are, in the vast majority of cases, very different from the wider market. So in terms of global value funds that we've seen increased demand for, they include Ranmore Global Equity and Artemis Global Income. And then within the UK, we've seen UK value funds like Temple Bar and Fidelity Special Values, which are both investment trusts, become more popular with our customers this year. What are your thoughts on this trend, Dave? Does this potentially speak to the fact that some investors are looking to diversify their exposure a bit more, especially given how strong global stock markets have performed in recent years?
Yeah, I think it's a couple of things. I think one factor might be, investor awareness. As you mentioned, classic growth stocks have run really hard. There are concerns about valuations. At points we've briefly seen what can happen when those stocks sell off. It can be quite painful. I suppose on the other hand, it's simply also that those funds have done really well in terms of performance, the value funds. I believe Temple Bar this year is very comfortably ahead of the competition in the UK, and the UK market is generally doing very well. Ranmore is very interesting, has performed very well. Artemis Global Income as well. So, and that might be down to things like, classic value sectors like financials having a really good recovery in recent times. So maybe people are just noticing that there are other ways to make strong returns rather than simply buying your global tracker or going for these big growthy funds.
And with value funds, they're of course hunting for potentially mispriced opportunities, and they're hoping that over time those low share prices will recover. But again, it's important to look under the bonnet and understand how the value fund manager is investing and what are the key qualities and attributes they're looking for in a company. They're typically looking for some sort of positive change, like a new management change, for example, or the business pivoting into a different area, such as a different type of product or a different type of service. So again, it's important to do your own research, look under the bonnet, and as ever, understand what you're buying. We're going to conclude by talking about the last trend that we've been seeing, and we've been seeing this trend play out more of late, and that is the increased demand for commodity-focused funds. In particular, we've been seeing stronger demand for gold ETCs, exchange-traded commodities, and also silver ETCs. What are your thoughts, Dave, on that trend? It's, of course, been a strong run-up in terms of the spot prices of both gold and silver this year, and also before that as well. I think gold has a really strong run over the past 2 years. What are your thoughts in terms of investors buying at this point?
So you can definitely call me too cautious or too bearish or too scared, but I do, when something runs that hard and when you see these enormous gains and all these record highs, I do start to think, is it a bit kind of risky to buy in? And maybe if you can't resist, if you have the kind of investment FOMO or you think it's going to go even further, then perhaps you just need to be careful and kind of have, smaller allocations. Don't put too much money into it. And just remember the general, not very exciting, but very important kind of diversification principles of holding other things alongside it. I suppose it's also interesting. There'll be lots of people who have been holding for, this year and have made these huge gains either on the metals or, the mining shares have done incredibly well, haven't they? So in those cases, you might want to think about kind of taking some profits and reallocating elsewhere. That is difficult because, many, many markets have done very well this year. So not lots of things are obviously cheap, but some of those rules of thumb might be able to kind of give you a steadier ride over time.
I completely agree. Position sizing is very important. In terms of position sizing, there's a number of wealth preservation investment trusts, the likes of Ruffer Investment Company and Personal Assets, and RIT Capital Partners as well. And, over the years, I've seen that their exposure to gold, it typically fluctuates between 5 to 15% maximum. Obviously, we can't give any financial advice or regarding how much to invest in gold, but I think it's safe to say that, with any high-risk asset, which gold does fit into, it is volatile over time, then you need to position size accordingly and not hold too much of your portfolio in that one particular area.
And also, it's just worth remembering why you're going to hold it, because I guess classically people have thought it's a safe haven. You're going to have some gold in case kind of markets fall over. But now, do you think people are maybe just seeing it as more of the price is doing really strongly, so it's a momentum play? And I guess you just need to consider what role is it going to play.
Because in terms of the sort of defenders in a portfolio, the ultimate defender is cash. And we've seen over the past couple of years, obviously interest rates rose from rock bottom levels to peak at 5.25%. They've since been falling, but interest rates are still at a high level compared to what they have been at for the last 15 years. And at the moment, you can still get around 4% on a money market fund, which at the moment, that's slightly beaten inflation. So in terms of looking for defensive areas, we've continued to see the Royal London short-term money market funds be really popular with our customers. It's number one on our II top 50 fund index. But I suppose going forward, the attractions of money market funds, they're going to be dictated by how low interest rates go, because the yields that money market funds offer, obviously the income, that's not guaranteed, but it generally is in line with the base rate.
I think what fascinates me here is, do you think the allure of those cash funds is going to go away, and what will drive that? Because yes, as and when interest rates fall further, the rate will get less attractive on that particular fund. But then, I don't know, are people also sticking with it because there's so much uncertainty? Because I would partly think this year, equity markets have done such big returns that you might be slightly drawn in and away from cash, but people are still kind of opting for that cash approach.
Dave, thanks for your time today.
Thank you very much.
So that's it for our latest episode. Hope you've enjoyed it. You can let us know what you think. You can comment on your preferred podcast app. And if you get a chance, please do leave us a review or a rating. Those reviews and ratings are really important to improve the visibility of the podcast and to get the podcast into more ears and grow it. In the meantime, you can check out more information and practical pointers on the Interactive Investor website, which is ii.co.uk. And I'll see you next week on a different day of Friday rather than Thursday. And I'll see you then.